This is chapter 1 on Principle of Accounting, first part, which is course 1110. The first, in this chapter, I'm going to talk about accounting and the business environment. Why do we need accounting? What accounting is important and what we have to do. Accounting itself is information system. Now, that information system has uh, particular elements which help us to do few things, a few activities. In the business world, and but not only the business world, in every world, we using that information or that information system which is combined in different sets of information to do specific activities. First one is to measure the business financial activity. As you already know from your personal experience, all of you have access to the information or to information system. One example for the information system will be your bank account. You have to go to the bank information system to log in your bank account, and then you're going to see interesting information. Based on that information, you can find different things. First, you can measure your financial activities. Same like accounting. From that information system that we have in accounting, I can measure the business financial activities. In your personal account, I can find your financial activities. What will be the financial activity related to? Obviously, for where the money coming and where the money going. How much we earn, how much we spend, how much left. From that information system, we're going to process the information and we're going to do the report. So basically, we have to do bank system, which is bank information system. Somewhere in the bank, coming the information about who send you money, who not send you, where you sending money, who take money from your account, from whom you're paying the money, all that information. Then that information is going to be presented for you and going to be processed through the bank system. And the only thing that you're going to see is a report. So basically, the bank itself is going to measure how much you're receiving, who's sending you that information, to whom you're paying, how much you're paying, gonna process that information, and you're gonna communicate with you that information in form of the report, which report will be your bank account statement. And in bank account statement, you're gonna see debit, credit, balance, description, date. Same thing as a accounting information system. So is the bank information system that you're using for your personal bank accounting, is it also can be called accounting information system? Absolutely. It has all the requisites the accounting information system has. Now, the fact that it's related to your personal account, it doesn't make it exactly accounting system, but yes, in accounting, we also use that information to measure the activities, which activities are generating income and spending the generated income or generating revenue, process that information in form of the report and communicating the report with, in this case, the users or decision makers. Now, in order to understand everything, we have to talk the same language, which will be the language of the business. What's the language of the business? Business wants to know a few things. How much I'm generating, from where the revenue comes, where the expense is going, how much left, whatever left, what I'm doing with it. Accounting itself will be type of language which kind of have specific terminology. If you think about it, Every industry, every area of knowledge has their own specific language. If you go to the biology, you have to learn specific terminology, which is related to biology. If you go to the physics, you have to learn specific terminology, which is related to the physics. If you become the doctor, you have again to learn specific terminology in order to communicate properly. What means that? That means there's a certain terms that have a definitions. It's something like not any different than learning another language. For example, you may have um, once you see water, once somebody tells you water, do you understand what the people are talking about? When somebody asks you, can you give me a glass of water? Do you know exactly what you have to do? How do you know that? Because you know what glass is and you know what the water is. One will be the experience, the other one is the knowing the terminology. Now, if you look at the dictionary and under the water, what we may find that the water probably is going to be liquid, which has no color, no smell, but helps you to for your thirst and contain 73% of the resources on the planet Earth, and is a very essential part for your body. So when you're asking, when you see somebody, what you're telling him, hey, can you give me a glass of liquid which has no color, no smell, which is essential part of my body, and you're going to help me with my thirst? Obviously not. The- You already know, and the person who you're asking, you both know that when you say water, you mean exactly the same thing. Well, same thing with accounting. In order we to understand each other, you to understand people who are doing the accounting, you have to speak the same language. In order to speak the same language, you have to know the specific terminology. Now, if you don't know the terminology, does it make you any different than the other people? No, that doesn't. The fact that you don't know specific terminology doesn't make any difference. The only thing is you have to equip yourself with a certain terminology in order to communicate in the certain area of expertise, which is the accounting or biology or medicine or chemistry, whatever you understand. So bookkeeping is part of the accounting, definitely, bookkeeping. So in why we need all these terms and all the different definitions in order to understand each other. Now, for the financial statements, what's the financial statement? Financial statement is, again, monetary information presented in form of the report, which have certain characteristics and answer certain fundamental business questions. What are those questions? One of the questions could be, is the business actually profitable? How are you going to find out if the business is profitable? By looking at a specific report, which gives me what's the revenue that this business generates, what the expenses which are related to that revenue that this business generates, what's the profit. Profit itself is not like a something that grows on the trees. It's coming from somewhere else. Profit is the difference between the revenue and expenses. So in order you to see is the company profitable, you have to see the report which contain revenue and expenses. If you tell me, for example, well, the profit of this company is $2 billion. Is that good for the company or bad for the company? What do you think? If somebody tells you, oh, this company is very profitable, makes a $2 billion, then some other people tell you, oh, this company is not that profitable, they're making only $100,000. Which company is more profitable now? The one that making $2 billion and the one that making $100,000. We cannot say, can we? So what do we need? We need a little bit. Exactly. It depends. It depends. We're missing some information. Now we need to see another report that's going to show us the revenue minus expenses, which give you the profit. And what's gonna happen if you find out that the company that make it $2 billion, they have a revenue of let's say $950 billion, and the expenses in $948 billion, and they're making $2 billion. The company that making $100,000, their revenue is $110,000, and the expenses are $10,000. Now, which one is more profitable, right? So this is the thing that we're gonna make that decision, but in order to make the decision, we have to see the specific report which helps us to answer those fundamental questions. Is the company making profit? How much is profit? How profitable is the company? The next question is, if the company is profitable, shall we hire new people? Shall we hire more staff? And how much gonna cost me if I hire a new person? How much will be the benefits of having that one? Then the other one will be, if I need to expand my business, can I afford to purchase a new equipment or new machinery or new laptop, or to purchase a building? Or should I lease the building? What should I do exactly? Those will be the questions that we try to find out by reading the financial statements. In your personal case here will be, when you look at the bank account, what you're thinking: should I take another course? Can I take 5 courses this semester? If you have a time to do it, and obviously you have to find the resources in order to do it. Now, for the users of financial information, obviously the accounting information again is presented, everything is measured, everything is prepared, analyzed, and presented in form of the reports. Who's using the reports? Well, we have different people. Some people want the report because they're part of the company. Some people want the report because they're not part of the company, but want to become part of the company. That's why we have individuals, which is the people who work in the company. We have business users, which may be again the part of the company or not part of the company, but those business users will be using the reports for different purposes to make decisions. Where individuals, when using the reports, they're just using it for the simply for the information. Now, two people can look at the same information, but because of they're using the information for different purposes, obviously they're looking for different things, and they can see different things. Now again, they're looking at the same information but seeing different things. Creditors, for example, they want accounting information. Why the creditor wants the accounting information for? What the creditor looking for? Who is the creditor? What can we get from the creditor? Why the creditor is so interested about that accounting information for the company? Well, simply, if you have your bank account and some point you want to purchase something, let's say a car, you're gonna go to the bank and gonna ask, "Hey, can you give me a credit?" Now, what they're gonna ask you? They're gonna start asking you, "Can you show me your income?" That means they need a financial report or accounting information about your income. Why they're looking for that? Because they want to evaluate, do you have ability to generate income? What do they need to know that? Because they're gonna give you money. What they want back, their money plus interest. So why they're so concerned about you be able to generate income or not? Because they want their money back. Sometimes you're thinking that, oh, they're very nice. They're asking all those interesting questions. They make me feel special. No, you're not special than anyone else. The only reason that you're special is because they want your money. You have something that they want. Otherwise, they won't be creditors. Make sense? If the bank just give you money to do whatever you want, it's not going to give you credit. They're not going to ask for the interest. They're not going to even ask for the money back. The only reason that they're asking questions, the only reason that they're so obsessed and so interested in your personal financial information through the accounting that you're having for yourself is to make sure that to assess, is this person have ability to generate cash? How fast I can get my money back? Can he pay me my interest? If I have check on all those things, if he a risky person or he is safe person, means that he generating steady cash. He's not between employment. He has a long-term employment with the same company for the long period of time, and I can see year after year how his income growing up slowly, slowly. That means he's stable. Do I want him as a source of income for myself? Absolutely. So what they have to do? Just gonna give him a credit. And then he becomes source of income for me. Why? Because now he's gonna pay me interest. Simple. Investors. Why the investors want to encounter information? Because they simply want, again, they want your money. No other reason. They just want your money. They want to find out, do you have ability to generate income? Do you have ability to generate cash? What's interesting with the investors? Investors are people who have what? Who's investing? What the investors have, so in order to make investment, or what they need to have in order to make investment. Do you know? Exactly, they have money. What they're looking for? They're looking for money. So that brings us to the very simple thing. In order to make money, you need to have money. So if you want to get more money, you have to have money. Then you become an investor. Now, which one is safer, to become a creditor or become an investor? Well, depends. Because sometimes, let's say I give today, this morning, the other group example. Let's think about this way. Uh, you're a newly graduated student from Douglas College, which having diploma, and you finish all the courses with A plus. You're going to the bank and asking, hey, can I have a loan of $20,000? What they're gonna ask you? Do you have income? No, I don't have income yet. But I have 3 potential job interviews next week. And I just graduated from Douglas College with A plus. Is the bank going to give you credit? No. No. Why? Because you don't have ability to generate cash. Now, let's go to the investors. Now, let's go to the investors and ask, hey, I'm newly graduated student from Douglas College. I'm all A plus everywhere. I have the knowledge. I have the everything academic. I even went to the co-op, and I was very happy. The people have exceptional comments from my co-op that I did. I have 3 potential interviews next week. Can you invest $10,000 in me? Now the investor is going to think about it, right? He's not going to be, now he's not a creditor, now he's not a bank. The bank assessing can you generate cash? Do you have a cash right now? No, I don't. But investors, he's going to look at this different point of view. And probably he's going to tell you, yeah, I can give you the money. But for my money, I want for the next 2 years, 10% of your income. Now, then you have options now. Should I back up from this or should I go for it? Right? That's the thing, right? So that's why the investors they want the accounting information to confirm that okay, I once I give you the money, I want to see now how you're performing. How did you do on that job interviews that you have last week? How you generating now the income? How you doing? Because I want 10% of your income now. The other users will be the non-for-profit organization. Non-profit organization, they need accounting information so they can report to the donors back how their money was used. The donors usually be getting more and more curious about how the money that they gave to the non-for-profit organization had been used and for what purpose they've been used. Government and tax regulators, of course, those people want accounting information and they start getting the accounting information in every possible way. Why? Because they want your taxes. They want my taxes. They want your taxes. They're not worried about, I mean, they're scared when we are not healthy. That's why the government gives you medical health system, not just because they like you so much, but because if you are healthy, you're gonna go back to work. And once you go back to work, you're gonna generate income, which I'm gonna take you money from your income as income taxes. And later, once you get your cash from your bank account, I'm going to wait for you to start spending your cash so I can get taxes again on form of a GST. So, uh, am I profiting from, am I getting the revenue from the individual if the individual is not healthy? No. So, what do I need? I need a healthy citizens or residents of my country. So, I'm going to provide them a medical system. Why? Because they generate revenue for me. I don't have to work now. They're working. As soon as they make money, I'm making money. As soon as they spend money, I'm making money again. Regardless what the individual is doing, what the residents of my country doing, I always making money. It's revenue for me. So I need the information of how much your income is because I want a piece of that income, and I need information how much you're spending because I want piece of your spending as well. Right? And then we have other users. So for that reason, we can split the information for two streams. One stream is the financial accounting, is the financial accounting, the other one is the management accounting. In financial accounting, we're going to provide information in form of the financial reports for the external decision makers, people who are outside of the company, the people who we're going to see later, they want to either give us money or lend us money or invest in our company. And the other main users are the internal users, which are the decision makers for the company, how the company uh, performs and what kind of activity we have in the company in order the company to generate revenue. That will be subject to management accounting. Management accounting is not, we're not going to talk about management accounting in this course. There's a separate area in the accounting, which is called managerial accounting. Very interesting. I strongly recommend you for those of you who wants to learn how to actually make money, go with the management accounting, get some knowledge about the management accounting, essential part. Financial reporting is just to provide the information based on what's already happened in the company for the people who are outside of the company. So they can make their decision, should I lend the money to these people or should I invest in that company? So I can get my money back or get more money. Wait a minute. Management accounting is going to give you, we're going to look at the same information, but then we're going to prepare a report for the how we can improve the situation. What should we do the next? How can we become better? How we can generate more income? Now, those are the two main branches of accounting. Financial accounting, again, dealing only with the reporting for the external users. Management accounting, assessing the current situation, provide the different reports for the internal users and advise them on what is the best within the company under the current conditions of the company. And then we have audit, then we have taxes, then we have finance, all different areas of accounting. Now, financial accounting versus the management, again, external versus internal users. External users, they're only and only worry about their money. They not worry about your money, they worry about their money. If I'm a creditor and give you my money, can I get my money back and can you pay me interest? If I'm investor, is if I invest in your company, how much I'm gonna get? What is it for me? That's why we have financial accounting. Management accounting is for the internal decision maker. How much we're generating, from where we're generating, which is the most profitable product that we have in our company, can we produce more? If we're losing on some product, can we change the cost structure of that product? Can we make something about it not to lose money? Shall we expand the business? Shall we not expand the business? How to do this, how to do that. This is the management accounting. If you want to know more, we have courses, management accounting. Strongly recommend you those courses. Accountants. Who is the accountant? Obviously, the accountant. Accountants will be a broad term of people who performing the same duty within the profession. Now, those people, they're governed by certain professional body, which in Canada is called Chartered Professional Accountants. So how you can find which person is member of this particular professional body? By the letters after the person's name. That's why we have those CPAs. Now the CPAs, they have to follow certain code of professional conduct, and we have a different type of, they can work in the public companies and they can work in the private companies. That's why we have the public accountant companies, which is perform the work for the public accountants dealing with mostly with the taxes and people's taxes and dealing with people's records, performing only the. And then we have the industry or private accountants. Private accountants, those dealing with a specific business, but now on the specific business. So in the industry or private accountants, they are not only dealing with the taxes and audit, they're dealing with all the other aspects of accounting, including managerial accounting, including finances, including the decision making, including the organization of the company structure and how the structure actually helps the owner to achieve their objectives. Accountants also have to have their professional conduct, which is governed by the accounting body. And the rules of professional conduct is focus on the confidentiality of the information. Obviously, information that accountants see is the very essential, very strict information. Not many people know about it. You know, one of the company that I was working here in Canada, one day, the owner of the company came to me and he told me this, and he was actually right. He told me that, you know what, I'm starting to get scared about you. And I said, how come? Well, you know more about the company than me, which was actually fact. I knew pretty much everything. What's happening in the company, how it's happening, why it's happening, and what I can do to change what's happening in the company. He didn't have that information. But of course, it's confidential information, so I keep it for myself. So one of the definitions that they face is once become accountant and teacher. For the definition for the accountants, I found this definition, which is very interesting. The accountant usually is the person who knows the most about the company and the business, but is less likely to do anything about it. So that's the privilege to be accountant. You're always going to have more information than everybody else. Unfortunately, you may end up to be not in the position to make decisions. That will function is going to be taken away from the owner of the company if you're not the owner of the company. That's why, on the other hand, to something to support this statement is, you know, I'm kind of like arts in terms of, I don't know, I find it a glass pieces made from glass, very unique and very appealing to me. I don't know if you know the glass industry and how the the certain sculpture or certain pieces of glass are made. You know, the glass it has to be heated under a certain temperature. Then there's a person, the old-fashioned way back in the days when there's no machine, anything like that. The person has to blow the air through the long tube, and that's how he forms that certain pieces. It's very interesting if you have a I mean, I find it interesting. Don't get me wrong here. You may not find it interesting, but if you have a chance, watch. You may learn something. But anyway, the point is that I knew the person who running a store with this kind of piece of glasses, which are very unique and done by the people who blowing the glass through the tube, old-fashioned way. And one day he asked me, "Hey, what are you doing for a living?" And I said, "I'm an accountant." I know he's the owner of the store. And do you know what he told me? He told me, in my next life, first thing before I open my business will be to learn accounting. Then I'm going to open the business. So what he's trying to tell me and what I'm trying to tell you is since we know the accountant is the one who most likely know everything about the company, but is less likely to do anything about it. If you are the owner and at the same time you know accounting, now you have ability to do something about it. That's something that you should think about. Next thing is to the maintain as an accountant, we have to maintain the professional reputation. Means we're not doing harm to the people, and we always keeping some kind of way of thinking and a way of doing the things to in order to um, maintain our reputation. We have to work with integrity, due care, and competence. Due care it means we have to see the things before they happen, and usually we do. So if you want to predict the future, join the club. A refusal to be associated with the false or misleading information, false misleading statements, compliance with the standards which are set up by the profession, independence. It's very important for the accountant to maintain their independency because when they're independent, then they can be objective. If you become a dependent, then you become subjective. That's one thing that is very hard to be maintained, to be independent, especially when you're paid by third party to do what you're doing. So technically, by being paid by the third party, you are dependent now. So how can you be independent when you're paid for somebody to do something and be independent? Audit. Audit is one of the area of accounting. For the audit to be auditor, again, you need to equip yourself with the different terminology. Now, the terminology that we're using in the accounting in this course is not going to be applicable for the audit. But the audit is simply examine the financial statements and express opinion about the financial statements in terms of is that those financial statements actually represent what truly happened in the company. Obviously, they have to maintain the ethical manners. Now, the relationship among the accountant and the business entity is obviously we as accountant, we're going to use the entire information system to present the reports and which we're going to give to the decision makers, which going to make decisions, which let's say, pretend those are external users. So they're going to make decisions about uh, their profit. How can I profit from this company when I'm seeing these financial statements? Public companies, those who issue for those who issuing the shares. So if decision making looking at the public company, then have to make a decision: should I invest? Should I not invest? Should I lend them money? Should I not invest? And then we have independent accounting company which perform the audit of the public companies to make sure that the decision makers, which are the investors and creditors, actually in fact have the correct information. Ethic in accounting and the business. Well, this is a fact. I don't know how it's right now. I have to renew my passport, I believe, next year. My Canadian passport expires, but the very first time when applying to Canadian citizen, uh, there's on the form you filling the form, and then you need the signatures, two signatures of two people, which has to be credible and have certain positions. The credible person from the society is considered was at that time was considered to be a lawyer, doctor, or accountant. So you have to have two signatures on your application for the Canadian citizenship and when you're applying for your passport. In order to get the Canadian passport, again, on that time, all time, I can remember, I don't know how it's right now, but your application has to be signed from two professionals. And professionals at that time was considered lawyer, doctor, or accountant. That's how important the accountant was, and that's how the trustful the accounting profession was in society. Now it's still trustful because again the accounting body, which is governed by the Chartered Professional Accountants, make sure that all the people who have those letters CPA after their names, they behave certain way, which is the proper way based on the code of ethic from that accounting body. Now, they cannot be influenced or pressured to record or present anything misleading, since accountants are in a special position. Users must rely on the financial information. That means that if I'm relying on financial information, accountants are the one that govern that information and make sure that that information actually is reliable. The external auditors, those intend to provide the users with the confidence, means the external auditor who review the financial information, they telling the public, hey, whatever you see, that's exactly what actually happens in the company, and you can go ahead or invest or lend this company the money because they are trustful. And you're always going to have the new regulation, reporting requirements, and anything. Now let's see the form of business that we may have in the company. So the business itself, it can take different forms. One of the forms of the business will be proprietorship or sole proprietorship in this case. The other one form of the business can be partnership, and the third one is the corporation. There's a difference between those three forms of business in terms of different activities and different liabilities, different categories. Let's put it as a categories. First one is by definition, proprietorship is the unincorporated business with only one owner. Partnership, on the other hand, is a business which has two or more owners. And corporation now is the organized business organized under federal provincial law as a separate legal entity. So then what that means? That means the proprietorship or sole proprietorship and the owner are the same person. So there's no separate legal entity. The partners and the partnership, those are the same people. There's no separate entity. Where the corporation and the owners of the corporation, they're separated. Now, in the normal for the owners, number of the owners, obviously in the sole proprietorship, that's why it calls sole proprietorship, we have only one owner. For the partnership, you need two or more. So if you want to open your business, can I open partnership? No, you can't. You have to have another person, which will be your partner, and then you can open partnership. If you only want to open business without incorporating the business, make it as a corporation, the only options you have is the sole proprietorship. If there are two of you, then you can do a partnership. The oldest partnership in the history of humanity, probably you already know, that's a marriage. It's a partnership. And later on in 1210, if you catch me, then I'm going to explain why exactly is that. Corporations is the owners can be one, can be more. There's no limitations here for the number of owners. Life of the organization, partnership, stop existing as soon as the owner of the business decides, okay, I'm done. Partnership, same thing. Once the partner decides, okay, I'm done, partnership is over. Where the corporation has indefinite life. What's going to happen with the owners, original owners? It doesn't affect the corporation. Corporations can change the shareholders many times and still be the same business as the corporation. Personal liability. Proprietorship is owned by his personal property. If something happened with the business under the sole proprietorship, the borrowers or the lenders can go after your personal property, whatever that personal property is. Partnership, same idea. There are some exemptions. Again, in 1210, we're going to talk more about the partnership. We have a special chapter for that one. Corporations, shareholders are not personally liable. They are liable, but only to the extent of their investment. That's it. Legal status for the proprietorship, owner is the business, are not legally separable. That's the same person. Same thing with the partners. We not separate them. Corporation is separate legal entity from the shareholders or the owners. For the taxation purposes, who pay taxes on the proprietorship? The owner of the partner of the proprietorship pays the taxes on his as an individual. On the partnership, same. Partners pay taxes as individuals. Corporation pay corporate taxes. Shareholders of the corporation, they pay the individual taxes. That's a different story. Type of the business. On the proprietorship, that will be small business. Once the business starts a little bit growing, now you have to decide what to do. If you're still by yourself, maybe you're going to incorporate. Maybe. That depends on so many things. On the partnership is usually that's the partners when they get together, that's because they expert in the same area, or you have the same, they have the same um, ideas and same goals. Once those ideas and goals start to deviating from one each other, the partners go different direction. No more partnership. That's it. Corporation is corporation. It can be one person, two person, three per people, how many you want. Let's go now for some concepts about accounting. Now, obviously, we have to prepare. One of the function of the accounting is to present the accounting information in form of the reports. Now, in order to prepare that information from the reports, we have to follow some principles, some underlying rules. There have to be some foundation on which we're going to build those financial reports. Who's going to set up the rules? Who's going to tell us what to do, how to do it? Who's going to set up the principles? Who's going to make the guideline to the process? That will be based on what kind of company we are and which are our users. So in order the accounting information to be useful for the users of the financial statements, not for the people who run the company, for the user financial statements, the company has to follow principles. Who set up the principles? Now, we have two types of principles based on what the company is, but generally the company's accounting system has to follow the general accepting accounting principles, obviously. The company is not going to follow the general accepting biological principles or general accepting chemistry principles. It has to be the accounting principles, which makes a lot of sense. So that is going to give us how to present the information, what to include in that information, what not to include the information, if it's that information, how to present it, if the different information, how to present it. Based on what the company is and where the company is reporting, we have international financial reporting standards, which are used by a company which is publicly listed on any world stock exchange. So if you're running public company, and if your shares are available for every users around the globe, you have to follow international financial reporting standards, which standards are developed by International Accounting Standard Board. If you're a private corporation, then you have options to use the accounting standard for the private enterprises, which are set up by the Accounting Standard Board in Canada. So again, for the publicly accountable enterprises in Canada, those enterprises have to follow international financial reporting standards. If you're running the private business, then you can follow accounting standards for the private enterprises, which is also governed by the Accounting Standard Board. Accounting Standard Board is the one who set up the rules. He's the one who's saying which company to use what. Now, in order we to have now the users to rely on financial statements and to know that they can rely on the financial statements, those financial statements have to be prepared under a certain framework. As you can see, we have a foundation and we have the top. On the top is always the objective of the financial reports. Then you're going to have some qualitative and quantitative characteristics. Then we're going to have the elements of the financial statements. And then we're going to have the key assumptions on which all those elements, characteristics, objectives can rely on. Let's start with the objectives. Obviously, based on who is the user of the financial statement, objective will be different. Most of the users, what they need useful information for whatever they want to do with that information. If we have a creditor wants useful information to assess the company ability to generate income so he can get his money back plus the interest. If you are investor, that investor you need the useful information in order to assess, is it profitable? Is it going to be profitable for me on the short term and long term period to invest in this company? Is the company is going to generate more income, less income? How exactly is going to be? So for different users, different objectives. Do we need to know those objectives? Preferably, yes. You as an accountant and me as an accountant, it's good for us to know who the users are, what's their objectives. Now, once we have the objectives of the users, then what they're going to look? They're going to look for is the information that you're preparing for me is actually relevant? Can I find everything that I need to know about the company? Is it reliable? Means if everything that has happened in the company, is it reported accurately? Can I compare it? Can I compare company to company, or can I compare the same company within the different periods of time? Are you treating the same events in the same way? Or are you changing your mindset from one event to another event? The last thing is, can I understand it? Now, interesting thing was if you have a chance to continue with the accounting, you're going to find that the International Financial Reporting Standards, the first thing that starts is exactly this. They comment about the basic characteristics and the framework under which financial reporting and accounting information has to be prepared upon. And under this specific characteristic understandability, International Financial Reporting Standard says this. Preparers of the financial statements are not responsible if the users of the financial statements, which are creditors, lenders, and investors, don't have sufficient knowledge to reach the financial information to some extent, or for some instances, the accounting information can be very complex, and they might have to seek a professional advisor in order to make rational decisions. But as a general qualitative characteristics, in order the reports to have a quality, the information has to be presented in the language which is understandable, clear, and concise for the users. Now, again, there might be special events which even those users need to seek financial advisors. In order, again, to be perceived and to meet the objectives and to follow to have the quality, the financial information has to be presented a specific way. In terms, you have to have elements. Which are the elements? Elements will be the assets, liability, and equity. And we're going to see later on what's the asset, what's liability, and what's equity, and what's in the equity. But briefly, in the equity, you're going to have this revenue, expenses, and gain and losses. And everything, all these assumptions so far, characteristics, elements, objectives, they align on certain assumptions, foundations, which is the foundation of the financial reporting or accounting. We have assumptions, we have principles, and we have constraints. Assumptions, some of the assumptions are economic entity assumption, means that all the events that happen in the company and all the accounting records contain only and only transactions for the specific business or specific entity. Whatever owner is doing in his personal life, that's not part of the business. And when the business, what the business doing, that's not part of the owners. So those are separated. Going concern assumption is we assume when we're preparing financial statement that this business is going to continue working on under this setup for the unforeseeable future. In other words, we assuming that the business is not going to shut down in 1 month or 2 months or 5 months. What's going to happen if we know that, if we find out the business actually, in fact, we're going to shut down in 5 months, then we're going to apply different assumptions, different characteristics to the financial statements. Next one is we all assuming when we prepare a financial statement that the currency that the company operates, the business operates, is under the stable monetary assumption, means the business environment is stable. Inflation is not so dramatic, so we can ignore the effect of the inflation. If the effect of the inflation become a player, then we're going to apply different assumptions, which are specific guidance going to come up with the um, standard setters, and they're going to tell us what we're going to do if certain events happen in the certain way. Then we have to apply the principles. Cost principle of the measure. So it means that the assets and the liability should be accounted for their historical cost. And obviously everything is going to have a constraint. Constraint will be one of the constraint is the cost benefit. Always cost benefit is constrained even for me sometimes. I want something so much, but the cost is constrained. The other thing that I can see is if the cost is more than the benefits, it doesn't make sense to have that. You always have to understand everything comes with the cost, but from everything you can get the benefits. And you're always doing the cost benefit analysis. As long as the benefits are more than the cost, then makes sense you to spend the cost. If the benefits are less than the cost, then obviously the natural answer will be no, thank you. Sometimes we're making compromises in our personal life, but for the accounting principles, we have to stay objective. In that case, we have to assess cost, we have to assess the benefits, and the benefits should exceed the cost. The last one is the materiality. Materiality. What is materiality? What is material? Now, in order to you to understand materiality, I'm going to go with the simple example, which I used today in class. Now, the example is this. Imagine for a second that we're not online, we're in the classroom. And after the lecture, you're going back home. Once you go back home, when the night comes, you're going to sleep, right? Usually you have normal sleep during all night, 8 hours sleep, everything's fine. And the next morning, after 8 hours sleep, you wake up refreshed, ready to another day. This is your normal course of action. Now let's introduce event in your normal life. After the lecture, you're going back home. Arriving at home, and once you arrive at home, you're finding out that you lost $5. Now the question is, are you gonna sleep and are you gonna have a good 8 hour sleep in the evening? By knowing that on the way back home, you lost $5. If the answer is yes, then that means the event which happened, losing money, and the amount that happened, $5, is not material for you. Means it doesn't change your normal behavior. You to have nice 8 hour sleep. Now let's change the magnitude of the event. Keep the same event, but let's change the magnitude. Again, you're leaving from the lecture, from the college, going back home. Once you go home, you find out that you lost $500. Are you gonna sleep now? Are you gonna have 8 hours nice, refreshing sleep? People in the classroom today say no. So what's happened now? The same event is the same. You lost money, but the magnitude of the event has changed. And the magnitude of the event become material, means change your normal behavior. Now you don't sleep. Now the question is, what will be the amount? What will be the level of the magnitude of the event that's going to become a material for you? And we come up with the amount of $20. So if you lose more than $20, then that event losing money become a material for you, you losing your sleep. If it's less than $20, you keep sleeping. Same thing with the use of financial statements. If we have to apply the same logic to explain the materiality. The magnitude of materiality will be, if I want to invest in the company and I find out by looking at the financial statements that there's a mistake, which mistake is in the range of $5,000, am I still going to invest in this company? If the answer is yes, I'm still good, that's not going to change my opinion about or my decision to invest or not. That means that amount is not material for you. If the answer is no, that means that amount is material for you. How this is going to change? How can you interpret that materiality in the cost-benefit analysis? Well, the materiality in this case will be, if the benefits are $2 less than the cost, would you still gonna buy the item? Let's go. Let's go with a simple example here. Imagine you're going to Starbucks and you're buying black coffee for $6. If you know that the benefits of buying $6 coffee is more than $10, obviously you're gonna buy it, right? You're making $4 right away. No questions about it. But now let's change the benefits. If you're paying $6 for the coffee and you know the benefits are only 5, would you still gonna buy it? Is the difference of losing $1 is material for you? If the answer is no, it's not material for me, because when the people see me with the Starbucks logo on my cup, they're gonna see me different way. And they're gonna invite me to new meetings which are not available for me, if they see me with Tim Hortons cup. Then yes, go for it. But if the benefits are $3 and you have to pay $6, and you say no, I'm not for this. That means that difference, $3, losing $3 is material for you, and that changes your opinion. That's how you should interpret the materiality. Let's go with the next one, the next topic. But before we start the next topic, I have a question for you. Now let's see what kind of business activity is going to affect the accounting records. That brings us to the accounting equation, the basic accounting equation. Like everything, then we have a rules, and then we have an equation. What's the equation? Equation is very simple. Equation is asset equal to liability and equity. Now, the question is, what's the asset? What's a liability? What's equity? Well, let's for the purpose of this course, I'll be using Excel, just to let you know. I find Excel kind of interesting and powerful, especially for you and for my students. So for that reason, I'm using Excel to explain some of the topics and some of the questions, obviously. So let's go with this one, and I'm going to share my screen with the Excel spreadsheet. I'm going to start this sharing first. Actually, I believe you see my Excel spreadsheet, have you? Now you should be able to see it clearly. So let's go to the basic accounting equation, which basic accounting equation again is asset. Asset is equal to liability plus equity. Now, at this point, probably that doesn't mean anything to you, but let's think about it. I mean, I'm gonna think about by talking with you, and I want you to get the idea of this accounting equation and how this is important for you. Mm, Asset is everything that you have. The money that you have in your bank account, that's your asset. Now, is that asset yours? That's the question. Well, depends. It might be yours. It might be not. Now, the other question is how much of your assets is yours then? Only the asset which left after you pay your liability. So if you own somebody money, if you haven't paid your bill for the cell phone, if you haven't paid your bill for the rent, if you haven't paid your bill for the credit card, then with the assets that you have, you still have to pay anything outstanding. So then what is yours? Whatever left on the assets after you pay your debt, that's yours. That's called equity. Now, what's interesting in this equation is, again, the assets, you can call it, that's my capital. Now, okay, if my assets are my capital, then from where my capital came from? Well, I can borrow it, but when they borrow it, they have debt. Or I can get somebody to invest it. Well, that's a good thing. So let's start digging on this and see how far we can go with this. Okay, so what that means, I want to start my own business. Why do somebody wants to start business? Usually the answer is to generate income. How can I generate income? Well, simply, in order to generate income, you have to have revenue first. I'm gonna make it a little bit smaller now, so I can use the sideways. You have to have a revenue, and okay, so I need the revenue. From where they're gonna get the revenue? From the clients. What do you have to do with the clients then? You have to sell them something. Okay, but I don't have anything. Well, you have to buy it first. So if I wanted to buy it, I need cash, but I don't have cash. I'm just starting my business. And if I have the cash, then I'm going to have expenses. And once I have the expenses, then I can generate revenue. And what will be my objective? My revenue to be more than expenses. Because if the revenue, my objective is the revenue to be more than expenses. Because if the expenses are more than the revenue, obviously I'm going to lose money. That means I'm in the wrong business of losing. I don't want to lose. Nobody wants to lose. Losing is not fun. So let's think again. I want to generate, I need income. The income is going to come only from the revenue minus expenses. No questions about it. And as long as the revenue is more than expenses, I'm going to have net income. That's what I want. But I cannot have the net income if I don't have the revenue. But I cannot have a revenue if I don't have the expenses. But I cannot have expenses until I have cash. So what I have to do first? I have to find the cash. From where can I get the cash? Well, the way I see it, you have two options. Either you have to have a liability, because that's equal to liability. Either you have to generate equity or get somebody to invest in your company. Otherwise, there's no cash. Okay, let's go. Find some cash. Now, we're going to the bank and say, bank, can you give us a loan? What the bank's going to ask you for? Do you have income? Um, yeah, I may have income because I'm planning to generate revenue, and my revenue will be more than expenses, and I'm planning to generate income. But in order to generate income, I need the cash because I don't have the cash. And what's the bank's going to say? Oh, hold on a second. You don't have the cash. No, I don't. Well, have a nice day. Go and get the cash and come back again. So that's zero. So if I want cash, what do I have to do now? I don't have much option. There's actually nothing left. I have to get investors. Who will be the first investor who give you the cash? Most likely will be you. You're the starting the business. You're the first one who investing the money, right? Why investing the money? In order to have a cash. So what with that cash to start the cycle, to get the expenses, which you're gonna buy something, then you're gonna sell it above the expenses, and that's gonna generate the revenue. And the revenue expenses, you make sure that the revenue is more than expenses. That's gonna give you net income, which is gonna increase your equity. So what's gonna happen with the income? It's gonna increase your equity. Now let's go on another thing, and let's think about it something. Once you know that the asset is equal to liability and debt. Let's do something very, 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 very simple. Let's go and buy a house in West Vancouver. How much we have to spend if we want to buy a house in West Vancouver? Most likely we have to spend, let's spend, how much you want to spend for the house in Vancouver? Give me some number, random number. 5 million. Okay, let's go with the 5 million. I like the number. 5 million. 1, 2, 3, 1, 2, 3. I want 5 million. Okay, boom, done. We have 5 million house in West Vancouver. Let's flip it without the zeros. Okay, great. Now what we have to do? We have to see how we're gonna get this house. The bank's not gonna give you a loan. The bank's gonna ask you how much down payment you're gonna put. If I put zero down payment, how much mortgage the bank's gonna give me? Hmm? What do you think? If I say I don't have money, the bank's gonna give me nothing. So nothing plus nothing is equal to $5 million. It doesn't work that way, right? Exactly, doesn't add up. So the bank's gonna say, okay, 5%. How much down payment you put? I put 5%. How much is 5% on $5 million? 0.05%. I put 0.5%. 5% only. And 5% is $250,000. I put $250,000. What that means to me? Well, let's see, what is that? $250,000. How much mortgage I have to get? $4,750,000. Can you see it? So now I have to get it balanced. Otherwise, my equation is broken. So I need here to have 4,750,000. Well, now I have a house. The question is, do I really have a house? Who has the house? The bank. Well, when the bank's going to give you mortgage, what the bank's going to ask you? As soon as you ask for the mortgage, first thing the bank's going to ask you, income or revenue. Once the bank asks you for the revenue, what's the next thing that you're going to ask you? The bank's going to ask you, where are your expenses? Current expenses, what are you paying for? So let's say you're going to the bank asking for the mortgage. Okay, the bank's going to say, show me your income. How can I prove my income? Give me the tax return. Give me the current letter from the employer, from your current employer. Show me that you have ability to generate revenue. Next thing I want to know is how much is your current expenses? Why do I need the current expenses? Why they need your current expenses? To find out how much your net income is. I can see your income, but I want to see how much is your net income. Because you need to live first and then you start paying me. So if I don't like this number, am I going to give you a mortgage? No. Make sense? So do you understand now the accounting equation? Assets or capital is always come from somewhere. Either it's going to come from the investor or as a equity, either it's going to come from outside as a debt. Now, in the corporation, both of those players are outside. The shareholders is outside of the company because they're separate legal entity. Now, in the proprietorship, obviously the equity is what the owners or the sole proprietorship or the individual has. Everything else comes from the debt. Ideally, what do you want? Ideally, I want this equation to look like this one to be 5 million here, and this one to be 0. That's what I want. How can I make it? By generating income. Once I have the capital now, I can start using that capital to generate revenue. Obviously, I'm going to have the expenses, but I hope the expenses will be less than the revenue. I'm going to start generating the income. That's not income here. Let's move that T, make it C. So once I get the income, that income is going to stay in the company and going to convert into as an equity. And eventually with that income, eventually I'm going to pay my debt because I'm generating cash, 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 cash. I'm going to wash out my debt and my assets will become mine. Now, when I go to the bank and ask for $1 million loan or mortgage, are they going to give me now? Absolutely. Why? Because I have my house worth $5 million. Not $1 million. They're going to give you at least $3 million. Obviously, you have to put the house as a collateral, and if you cannot pay the $3 million, they're going to take your house, but that's a different story. Make sense? All right. So that's your basic accounting equation. That's what I want you to understand. Asset is always equal to liability plus equity. Now, from here, what we can get? Let's get this accounting equation, basic accounting equation. Let's working with this accounting equation. Once I have this accounting equation, what else I have? Something very interesting. From this equation, can I express equity in equity only? What's my equity equal to? What will be here? That will be my asset, correct? And then I'm going to have minus liability, correct? So what my equity represents? Asset minus liability. Well, what is asset minus liability then? Less liability is going to give you net assets. So in that case, net assets is equal to my equity. So if somebody asks you how much is your equity, what he wants to find out? He wants to find out how much are your net assets. Yes, I have $100,000 in my bank account, but I have to pay for my mortgage, I have to pay for my car, I have to pay for my outstanding student loan, and I have to pay for my cell phone, and I have to pay for, hold on a second, how much you have to pay? A lot. Make sense? So yes, you have assets, but I also have a liability. Is it possible equity to be zero? What do you think? Is it going to be possible equity to be zero? Yes, absolutely. If you don't have if you or only you have a debt, and all the with all the assets you're covering your debt, obviously your equity is zero. Let's get another thing here. Let's another thinking here. With the house, 5 million house. Let's express this one. I'm gonna push this one down a little bit. And let's go with something else. Can I express asset as a percentage? What will be that? If I want to express asset as a percentage, going to be asset divided by asset, right? And how much will be the asset divided by asset? It's going to be 1, correct? Number divided by the same number is going to be 1. There's no other options here. 1 as a percentage is going to be 100%. So what I have on one side, I have 100%, which is my asset. What do I have on the other side? Combination of two numbers. Can I have more than 100% on the other side of the equation? No. Do you understand this? So if I have here 100%, what I have as a liability? 0. Is it possible to be 50 or 10%? No, then it's 0. So what's going to happen? If my equity start going down, if I have with the same thing with the house here, I put 5%. I invested 5%. So that means 95% of my assets is financed by debt on the mortgage side. And 5% I investment. Eventually, I want to, if I make it 50-50, then what's going to happen? My equity is going to be 2.5 million and my debt will be 2.5 million because I have $5 million assets. Make sense? So how this going to work? Is it going to work as a percentage? Is it going to work as as the numbers? It doesn't matter. You always have to keep in mind the asset is equal to debt plus equity. Yes, that's the only way you to keep the equation. That's how simple accounting is. So now let's go back to the slides and let's keep going with the slides. I'm gonna stop sharing this and gonna move to the slides. So based on this, assets are our economic resources which we're using to generate revenue. And those economic resources are either finance with debt or liability, either finance with equity. Again, assets will be the economic resource which is controlled by the entity, which expect entity to generate benefits in the future. What will be the benefit in the future? Revenue. The only reason I need those assets is to generate me revenue. Because if they're not generating revenue, I'm not going to have income. If I don't have income, I cannot pay liability or to pay the investors for what they want. Example for the assets will be cash. It can be accounts receivable and can be not receivable, prepaid expenses, land, building, equipment, furniture, computers, machinery, car, anything that you can picture, everything that can be used for the entity or the company or the business to generate future benefit, which will be the revenue. Liability. What's a liability? Liability is current outstanding debt for something that we did in the past for which we have to pay in the future. The only reason why you have a liability or you may have liability is because you didn't pay at the time that you acquire whatever you acquire. If you have paid for it, you won't have a liability. For example, can I have a liability if I go with this? There's sometimes there's those truck hot dog people which selling hot dog. Is it possible I to owe them money when I buy my hot dog? Do you know what I'm talking about? No. Why? Because if I don't give them $10, they're not gonna give me hot dog. On one hand, they holding the hot dog, in the other hand, they want to have the $10. Once I catch the $10, I'm gonna give you hot dog. If you don't give me hot dog, if you don't give me $10, no hot dog. Sorry. So are they gonna have accounts payable? In that case, is it possible for me to generate accounts payable in that transaction? No. What the accounts payable again represents amount that we owe for something that we did in the past, which we have to pay in the future. Then we're going to have those accrued liabilities. Accrued liability, we're going to explain later what exactly is that. Then we're going to have notes payable and unearned revenue. And again, unearned revenue, I'm going to explain in the next lectures what exactly is that. And then the last thing that left is the owner's equity. Well, what's the owner's equity? We already saw what is it. Owner's equity is simply assets minus liability or net assets or from the assets that you have. Once you pay outstanding debt, whatever left, enjoy it. That's your equity. Now for the owner's equity. Now we're going to expand it a little bit. Owner's equity will be the capital that, or the investment, initial investment that the owners made. In our case with the house, the owners put $250,000. The owners can withdraw money from the company that will reduce his equity. Revenue is going to increase, always going to increase the owner's equity, and expenses always going to reduce the owner's equity. Now, again, owner's equity itself. What's going to increase the owner's equity? Every time when the owner invests more in the business, it's going to increase the owner's equity. Or if the business generates revenue, that's also going to increase the owner's equity. What's going to decrease or reduce the owner's equity? Every time when the owner decides to take the money from the business, that's going to reduce owner's equity. What else is going to reduce the owner's equity? If the business starts generating expenses, which we already saw, you cannot generate revenue if you don't have expenses. So that's also going to decrease the owner's equity. Then we have the revenue. What's the revenue? Revenue is something that has been received or you gonna receive. Why? Because you give something to the customer, either goods, either provide services. So example of the revenue can be service revenue, can be sale of merchandises, can be renting the space, can be interest. For the investors who usually lend money, they're gonna generate revenue through earning the interest. For the owners of a property, he's gonna generate revenue by renting that property, and that will be rental revenue. For the person who buying and selling merchandises, he's gonna have sales of merchandises. For the person who delivers services, he's gonna simply generate service revenue. Now expenses. What's the expenses? Expenses is something that has been already paid or has to be paid. For what purpose? To earn revenue. Make sense? The only reason that I'm having expenses in the business is only one, to earn more revenue. If the expense is not to earn revenue, then it's not part of the business. What's going to happen with the revenue? Again, the revenue is going to increase the owner's equity, but the expense is going to decrease the owner's equity. Example for the revenue can be rent expense, can be insurance expense, can be salary wages for your employee, can be advertising expense, can be utility expense, can be any other expenses, office expense, interest expense, bank expense, some other expenses, which is legal expenses, which is related to the business. So many expenses. So how the accounting equation is going to look now? It's going to look like this. We're going to have assets, and the asset is going to be equal to the liability plus the owner's equity. Now, under the owner's equity, we're going to have what the owner invested minus what he withdrew from the company, plus whatever business generated as a net income from the revenue minus expenses. If the expenses is more than the revenue, sorry, Mr. Owner, but you generate net loss. So your equity is going to go down. Next period, make sure that the revenue is more than expenses. Now, once we have those ideas, now we can start doing start running the business, and we're gonna start having the transactions. Now, in order we to have a transaction, the event that happened, we have to be related to either asset, either to liability, either the owner's equity. Now, under owner's equity, again, we have revenue, expenses, withdrawals, or investment. So if we see something, if we see transaction which happen with the business, which can be defined as a purchase of asset or use of asset, liability, owner's equity, investment of the owner's withdrawal, revenue, expenses, we have to record it as a transaction. That transaction is going to become a part of the accounting system, which accounting system we're going to later prepare the report and we're going to show it to the user financial statements. So first requirement is the transaction to have effect on any of those elements here. Asset, liability, revenue, expenses, owner's withdrawal, owner's capital. And the next thing, it has to be measurable. We have to measure it, and that measure has to be reliable. How we usually measure things? In dollars or in currency. If you cannot measure it in currency, you cannot record it as a transaction. Make sense?